Welcome to this new episode of Your Next Trade, where Nvidia bets 100 billion on ChatGPT. So on Monday, we saw the announcement between ChatGPT, OpenAI, and Nvidia about a 100 billion deal. So more or less, what ChatGPT is lacking is a bit of, that's an understatement, of capital. So going forward, they need to invest between 500 billion to a trillion. We are talking massive money. If you remember, in January, they announced the deal with Oracle and the Japanese SoftBank for the capex for the next 5 years, and where we are talking about 500 billion more. But for the time being, those companies, those hyperscalers, are lagging some revenues. So what they need to do is obviously getting financing, and there is limit to financing like any company, even if you're AI. So the deal between Nvidia and ChatGPT is about Nvidia providing chips to ChatGPT, and in the meantime, with this buying of 100 billion, guess what? Nvidia will be taking some of the shares of OpenAI. So on one hand, you can argue, so this is a good thing because OpenAI, meaning the whole space of AI is growing nicely and is growing even more. On the other hand, there is a bit of sense of feeling that it's probably back to 2000 when there is a bit of round tripping where you sell actually to yourself as a company. So there are many, many question marks here on this deal, and it feels pretty much like after the Oracle deal that was announced, same again with OpenAI ChatGPT, that we are a bit running full circle around this AI space. So there have been some question marks. There have been people like the hedge fund Einhorn saying, going forward, it feels almost impossible that all those companies that are spending trillions will be making money. There was a good report from Bain saying, those companies will have to generate roughly 2 trillion revenues in 2030, but it feels pretty much that they will be short of 800 billion. And finally, a very good report from JP Morgan saying, pretty much that this market, we are talking stocks, is only driven by ChatGPT/AI semiconductors since November 2022 and the announcement of OpenAI. 75% returns of the S&P 500 is coming from AI. 80% of the earnings growth are coming from AI, and finally 90% of the capital spending is from AI. So this is a huge bet that the market is taking. If you think about those companies, what they will try to achieve is they will need to be making a lot of noise, a lot of marketing noise to make sure that they're going to get the financing and having this financing as cheap as possible. And we are talking about the credit spreads. So this is why you see announcement after announcement that the whole world is going to be about AI. If you look at the numbers, it's pretty much like you're going to have some winners, but you're going to have like some massive losers. So looking at what happened for the market for this week, looking at the week to date, actually there has been a bit of a pullback. We are talking a very small one, looking at the S&P that is roughly flattish, but we went up on Monday on this announcement deal, and after that, we came down from the highs roughly barely 2%. So if you look at the day-to-day intraday from the highs to the lows, it was just below 2%. So we are not even talking about a 2% correction on an intraday basis. So overall, market small down for the week. We are talking for the S&P, for the Nasdaq, and for the Russell. Rest of the equity market are roughly flattish, except India that was down 3%. Dollar was pretty strong this week. We had some kind of a reversal from Wednesday onwards. As we're going to see later, this is something that is very important, looking at yields and how the yields have been moving the different asset classes, and we are talking stocks. This is something that we mentioned at the end of last week on the call, saying bonds have been under pressure, yields have been going higher. And normally you should see a correlation, and we are saying that there was a good chance for the stocks to be down by 2 to 3%. We're going to be looking at how it has been impacting the dollar. Crypto, Bitcoin under 110, Ethereum under 4,000. So a bit of a reversion in that space from the highs. We are talking 80% from Ethereum from the highs, but still very strong since the early July. Commodities, we are still going for the assets, the real assets. We are talking gold, we are talking WTI and copper, all up more than 2%. So what about the week-to-date industry performance? This is really an interesting picture. So here we do have like the S&P 500, we do have like the Nasdaq, so roughly flattish. But as you can see, tons of underperformance. We are talking some cyclicals. We are talking airlines, or online retails, on builders that have been under pressure because yields have been up. Other end of the spectrum, as we flagged, WTI very strong, as we're going to see with technical analysis at $66 now. Oil services were very strong on Thursday and Friday, particularly. Gold miners making new highs after new highs, utilities as well. So pretty much the commodity space on the right-hand side, hard assets, and on the left-hand side, anything that is a bit cyclical. But as you can see as well, semiconductors very, very strong. So semiconductors are a big chunk, a big weighting of the overall market, and that explains for a big part why the S&P was flattish on the week. So on the sector performance, you see the same picture. Utilities, energy, very, very strong. Materials, cyclicals a bit struggling. And as well, consumer staples, actually defensive, have been struggling. So what about the rates? Looking at the US 10 years, this is interesting and important. We went below the 4% not so long ago, saying, the Fed is cutting, the world is good, inflation is coming down. And despite the Fed cutting, guess what? Yields have been on the way up. We are talking 4.18%. We are talking 5 bips, 0.05% of the week. So literally, the market is now saying that the economy is still very strong, and looking at the Fed funds expectations. What are the expectations going forward for market participants in terms of the Fed cutting? Not so long ago, it was about cutting in October and in December, so both 25 bips. So the October cut is probably valid around 80 to 90%, but for in December, the odds have been really coming down quite significantly. Why? Because because the GDP was revised up. That was on Thursday, with very strong actually consumption. So the US consumer is doing very, very well. That was the same picture that we had from the retail sales. So it's what is the market telling us these days is good news, is probably bad news. In terms of macro. Why? Because when the news are too good, that means the expectations for the Fed to cut have been lowered, and that puts a bit of pressure on stocks. What about the VIX volatility? We are still around 15%. So we rallied a bit for the VIX after the expiry on Tuesday and Wednesday as expected. And as we discussed last week, after the expiry, there is very often a repositioning where market participants are putting some positions again. What is interesting as well is, there is a ton of sometimes when the market is going higher with volatility actually going higher. And that normally happens only 10% of the time. The reason is people are buying very much the tails. And we are talking very often with the short-dated options and up to 30 days. We are talking tons of call options as well. So I want to go now into, as always, with the technical analysis. So let's start with the euro dollar. And actually, you can see that we went until up to 119, but we gave a bit back over the last 5 days. 118 to 117, 116.50 very quickly. That's only 1%, but really there was a lot of question about why was the dollar so strong. And the reason is the US 10 years, it's the Fed fund expectations, really big move on the US 10 years. I don't do technical analysis, don't get me wrong, on the yields. I'm just looking at the levels. And as you can see before, we have been trading for quite some time between 450 and 480, or let's say 450 to 60. We went below that level. We tested this again, this is not technical analysis. Now we are back to this level. This is an important one. What about the S&P futures? We came back a bit from the top of this trend that we have been flagging, but the trend is still your friend, still very strong, a bit different from the Russell 2000, which has been making a triple top. If you go backwards, you see this top here, and this top. So that gives you a triple top. And this is really one of the charts that I'm looking at to see if there is a broadening of the US market. But the trend has been tested most recently. So keep an eye on that one. As I said, WTI oil pretty strong for this week. So there is obviously some questioning about, is the conflict between Russia and Ukraine be spreading to the rest of the world, of Europe. There has been some strong wording from Trump saying that actually Europe should be shooting down any planes, Russian plane that is crossing the border. So it's almost like there is a green light, or actually there is a change in the rhetoric coming against Russia. So you see, I mean, it's not a massive move, but we are talking again going back into the 66 level. You see the 200 moving average. So this is a space to monitor. Another one is obviously crypto, where we had, as I said, Ethereum now trading below the 4,000 level. If you look at Bitcoin, we are talking trading below 110,000 level. So if you believe in the risk on, risk off, and what is interesting is there have been tons of noise of we are spreading, and a lot of investors that were on the sideline for cryptos will be going into that space. And actually, if you look at crypto, we are back to the level from early July. JP Morgan, I like to be looking at that one to get a feel of, are we in a risk on and risk off mode? And as you can see, JP Morgan is saying the world is pretty good. US are growing nicely. We're going to be having in 2 weeks' time the start of the earnings season. And as always, we will be starting with JP Morgan. Finally, AppLovin that we discussed last weekend with the inclusion in the S&P 500. The trend is still, my friend, very, very strong. We get tons of new flows into that space and into that name. It's like the Robin Hood and some others. So story is the same here. Let's go back into Excel and looking at what happened for the week. So we had a bit of macro with the flash PMIs, which actually were not that bad. We are talking for both the manufacturing and services. I'm going to be starting with that chart, which is the S&P futures for the last 5 sessions versus on the right-hand side, as you can see, the futures of the 10 years. I flagged the correlation between the two. That is important. And as you can see, the S&P futures again have been outperforming in terms of correlation the 10 years. So there is a question as now we are at 418, 420 on the US 10 years, when and if we could have a bigger correction for the S&P. You look the same kind of correlation between the DXY, the US dollar. So on the left-hand side and on the right-hand side, this is the US 10 years. You see the strong correlation. So the move that we had on Wednesday and Thursday for the strong US dollar was mostly explained by, as we discussed, the GDP that was very strong, with a strong US consumer, with the market saying the odds of actually the Fed cutting rates are going to be lower, and that explained as well the strong dollar. So we had tons of Fed speakers for the week. It's a bit messy. There is a conflict of messages around those people. So I think when there are too many of them talking, that the message becomes very messy. The PCE inflation on Friday, similar to the CPI, same message. We are plus 2.9% year on year. As we have been saying again and again, the 3% is the new 2%. So the market so far and the Fed is okay to be running higher inflation. Bonds, yields up, US bid, and finally we had the Nvidia ChatGPT. And I want to flag as well the some reversion to the mean. So this is, all these indexes that have been built by different brokers like Goldman Sachs and some others. And as you can see for the week, the sectors, the indexes that have been struggling is anything like momentum, private equity, anything that is means the low profitability. We are talking down roughly between 1 to 5%. And that explains why the market came down a bit. But this is only a reversion to the mean. If you go back into how the performance has been over 1 month or 3 months, very, very strong. So we only gave back a bit of performance for those meme stocks. We are talking again those same names. So it feels pretty much like retail is still in control, that the flows into stocks are still very, very strong. And so far, that the market has been digesting very well the bad seasonality that usually we have in September. We are going into the end of September, so that means there is a bit of repositioning, for example, for the JP Morgan collar, which used to be at 6505. So that will be on Tuesday for the rolling of those positions. But so far, as I said, September market has been doing very well. If you look at October, November, and December over the last 30 years, the seasonality for the S&P 500 has been pretty good. So what about this week? We got tons of macro. We got to have a bit of earnings, but mostly it is about housing, starting with the housing price on Tuesday. But most importantly, we got the ISM PMI manufacturing, the ISM's PMI services on Friday. Obviously, NFP is very important because the Fed is looking at it. I think the expectations are around 50 to 60,000 job creation. You don't want to see a very bad number. So market is wishing for actually an inline number. What about in terms of earnings? We do have like Nike on Tuesday. That is something in the trading community, and many of my actually mentees at the start of the year were involved on that name. We do have like a bit of Fed speakers, not that many, not much of bonds auction. This is mostly are going to be T-bill. So we got the job market on Friday. We're going to have ISM manufacturing services. As you can see for the NFP days, how the market has been moving recently. The last one, it was almost flattish on the day. Expectations, as you know, the VIX is around 15%. That translates into a plus minus 1.2% for the week. Realized volatility has been a bit up, but still there is a divergence between realized and implied. Was implied in terms of points way too high versus realized. Finally, there's a lot of talks about government shutdown at the end of this month. If you've been trading for more than 3 months or 6 months, you will know that actually this is something that comes over and over. This is a bit of the American show where there is a bit of noise and people are going to tell you it's the end of the world. If you look at this good table built by Trist, that tells you that most of the time the market is doing zip around the government shutdown, and that actually the US could be functioning very well despite all this noise. So this is for this week coming, new month. Look at on Tuesday, the role of JP Morgan, and as well, probably what we're going to see in the last hour trading session is some funny moves. So this is it for me for this week. We had quite a new people coming and joining in terms of both the mentoring and the trading community, and more viewers on this YouTube channel. So this is a good news. If you got any questions on the 4x4 video series, if you get questions about the trading community on Discord, where we have one channel mostly, but we got 30 channels beyond the paywall, please send me an email. Any questions about the process, how I can help, I'm obviously happy to do that. You can send me an email at greg@duponttrading.com. This is it for me for this week. Have a good trading week. Bye-bye.